In the first quarter of 2026, global energy markets faced intense geopolitical volatility. Shipping constraints choked the Strait of Hormuz, bottlenecking a critical supply artery. A logistical chokehold of this magnitude typically triggers a corresponding hit to supplier margins. But Saudi Aramco's quarterly report reveals a massive, uninterrupted flow of top-line capital. This model shows the company's top-line revenue reaching $124.5 billion for the three-month period. From that, Aramco extracted an adjusted net income of $33.6 billion. That profitability directly funded a $21.9 billion base dividend to be paid in the second quarter. At the same time, return on average capital employed, evaluating how efficiently a firm utilizes debt and equity, held strong at 20.7%. These numbers reflect a mastery of infrastructure agility, allowing the firm to decouple its financial performance from regional bottlenecks. Aramco relies on a physical hedge. Rather than exclusively utilizing financial derivatives, the company leverages massive, redundant domestic infrastructure to bypass global choke points entirely. At this scale, the ability to physically reroute millions of barrels acts as a buffer. It is the mechanism intended to keep the massive $21.9 billion dividend stable, even when the primary trade routes are compromised. To understand how this physical hedge works, we start with the upstream segment, which remains the primary engine of Aramco's global revenue generation. Comparing upstream earnings to production volume, first quarter adjusted EBITDA hit $54.1 billion against 12.6 million barrels of oil equivalent per day. This was driven by higher crude volumes and a strong realized price of $76.90 per barrel. But generating volume is only half the equation. With the Strait of Hormuz bottlenecked, that volume still had to reach international buyers. The solution relied on contingency infrastructure originally designed decades ago. Aramco's legacy pipeline network was built explicitly to provide logistical optionality during regional conflicts. As the supply shock materialized, Aramco triggered its business continuity plans and sharply ramped up the East-West pipeline to its absolute maximum capacity. This map illustrates the maneuver. Instead of pushing into the Persian Gulf, 7 million barrels of oil per day were successfully rerouted to alternative export terminals on the kingdom's west coast. By utilizing this bypass alongside massive domestic and international storage reserves, Aramco delivered its supply to market on time, fully securing the upstream segment's revenue. That secured revenue allows the company to maintain an aggressive posture on growth, committing $9.8 billion in capital expenditures to upstream projects during the quarter. A key objective of this spend is maintaining a maximum sustainable capacity of 12 million barrels per day, supported by ongoing construction at the Zuluf and Dammam increment projects. Preserving 12 million barrels of daily capacity and actively utilizing a 7 million barrel bypass route, this physical redundancy directly underwrites that $54.1 billion upstream profit. The downstream segment, however, faced a much more volatile operating environment. Downstream adjusted EBIT landed significantly lower, posting $5.0 billion for the quarter. This figure reflects conflicting internal pressures. While refining margins improved compared to the previous quarter, chemical margins weakened considerably. To combat this margin weakness, Aramco executed an aggressive portfolio optimization strategy through its SABIC subsidiary. SABIC signed agreements to divest its European and American petrochemical and engineering thermoplastics businesses, offloading them to Mutars and Equita. Under accounting standards, authorizing a divestment requires assets to be reclassified as held for sale. This immediate valuation update triggered a $46.9 million remeasurement loss for the engineering thermoplastics business. Absorbing a short-term accounting loss in the downstream segment is a calculated mechanism. It allows Aramco to clear underperforming assets from its balance sheet, streamline its global portfolio, and protect its chemical margins over the long term. Moving from the income statement to the statement of cash flows reveals exactly how Aramco manages its actual liquidity. This waterfall chart maps the company's capital allocation. Operations generated $30.7 billion in operating cash flow over the three-month period. From that total, Aramco subtracted $12.1 billion to fund its capital expenditures. That leaves a free cash flow figure of $18.6 billion. This introduces a mathematical tension. The $18.6 billion free cash flow is lower than the $21.9 billion base dividend. This cash gap was driven by a $15.8 billion working capital build, meaning billions were temporarily tied up in operational necessities like inventory. To bridge this liquidity gap and fund the dividend without aggressively draining its existing cash equivalents, Aramco optimized its debt structure. In February, Aramco completed a $4.0 billion international bond issuance. Split across 4 tranches, these notes lock in funding with maturity dates stretching to 2056. Additional liquidity was secured through long-term debt drawdowns executed by subsidiaries, including a $0.53 billion external financing arrangement by Sawtorp. The board of directors also approved a share repurchase program, allocating up to $3 billion over an 18-month period, primarily to fund employee share plans. Taking on new debt to cover the dividend and fund repurchases shifted the company's gearing ratio, pushing it from 3.8% at the end of 2025 up to 4.8%. A 4.8% gearing ratio indicates that despite a heavy working capital build and new bond issuances, Aramco successfully funded its massive dividend while remaining virtually unleveraged compared to its global competitors. Securing the current quarter's financials relies on existing assets, but Aramco's capital expenditures point toward a strict technological transformation. The company is actively transitioning capital away from legacy oil developments and toward expanding natural gas and natural gas liquids infrastructure, driven by projects like the Jafurah and Fadali gas plants. The next phase of structural optimization requires shifting reliance from physical steel pipelines to advanced digital networks. Expected by early 2027, this system will deliver 7 times the compute capacity currently available to the company's upstream operations. At the same time, Aramco completed the network integration for a Pascal quantum computer, laying the groundwork to apply quantum mechanics to logistics routing and network optimization. To protect these digital assets, the company initiated a strategic partnership with CrowdStrike, embedding AI-powered threat detection directly into the operational technologies of its energy and chemical facilities. These digital investments operate as the modern evolution of the physical hedge. By utilizing artificial intelligence and quantum data, the company can predict supply constraints and optimize routing well before a physical disruption occurs. Facing intense geopolitical volatility and choked global shipping lanes, Aramco still delivered a quarter with $33.6 billion in adjusted net income. That performance clarifies a central reality of global energy markets. Elite financial engineering and massive shareholder returns are entirely dependent on the physical and technological infrastructure built to protect them.